All right, let's talk Nike. I mean, when you think of a truly global dominant sports brand, what comes to mind? It's that swoosh, right? It's just iconic. But believe it or not, this seemingly unstoppable giant has been facing some of its biggest challenges ever.
And to see what I mean, just get a load of this number. On April 1st, 2026, Nike's market value dropped by over $20 billion. No, that's not a typo. And that wasn't over a few months or a year. That was in a single day. A loss so massive, it sent shockwaves through the entire industry.
So that's the big question, isn't it? How on earth does a titan, a company like Nike, end up in a spot like this? Well, that's exactly what we're going to unpack right now. So let's kick things off with the moment it all really came crashing down. You could almost call it a perfect storm of bad news that just blindsided investors.
Yeah, the immediate fallout was, well, it was brutal. A 15.4% crash is absolutely massive for a company this big. It pushed the stock to a price nobody had seen in almost a decade. It was clear investors were running for the exits, spooked by something huge.
And here it is. This was the bombshell. During their big earnings call, the leadership team dropped this, quote, shock revision. They weren't talking about a small dip, a few percentage points. No, they were forecasting a 20% plunge in sales in Greater China, a market that for years had been their #1 growth engine.
So what happened? Why the sudden catastrophic collapse in China? And what else is going on here? Well, it turns out Nike is basically fighting a war on two fronts, getting hit by two very different but very powerful headwinds.
Okay, so you can really split their problems into two buckets. On one side, you've got a pure financial gut punch from new tariffs. Pretty straightforward, but painful. And on the other side, you have this much more complicated, almost existential crisis happening in their China market, driven by some really powerful cultural shifts and incredibly tough local competition. Let's just put a number on that first problem, the tariffs. The reimposition of these duties is expected to cost Nike about $1.5 billion a year. This isn't just some line item on a spreadsheet. It's a direct, massive hit to their bottom line, eating away at their profits.
And this chart, wow, this really highlights that second headwind. While things are actually looking okay in North America, with 9% growth, look at what's happening in Greater China, a 17% plunge. That's not just a slowdown, folks. That's a full-on collapse. The contrast is just stark.
So if you want to understand the why behind that collapse, you've got to understand this term, guo chao. Seriously, this isn't just a trend, it's a cultural tidal wave. Younger Chinese consumers are now deliberately choosing local, domestic brands. And here's the key part. It's not just about national pride. They now see these brands as being technologically superior. The old days where you could just slap a Western logo on something and charge a premium, yeah, those are over.
Okay, so facing this full-blown crisis, Nike is not just sitting on its hands. They've rolled out a new playbook, a whole new strategy they're calling Win Now, and it's all about stopping the bleeding and clawing their way back to the top.
And this strategy really has three main parts. First, they want to get back to basics and just dominate product innovation in their core sports. Second, they're trying to fix their marketplace by rebuilding bridges with big wholesale partners. And third, they're shaking things up internally, reorganizing to try and be faster and more nimble.
Thank you for watching. Please like and subscribe to our channel.
Well, when you start to look at the cold, hard numbers, it becomes really clear that this turnaround is, no joke, a massive uphill battle. The strategy, at least so far, hasn't really shown up in the financial results. I mean, just look at this timeline. It's brutal. You can see the value of the company just bleeding out year after year after year. To go from a high of $183 billion just a few years ago, all the way down to $68 billion, this is not a blip on the radar. This is a multi-year crisis of confidence from investors.
And if you were hoping their latest report card would offer some good news, well, it doesn't. Revenue is flat, which is already not great, but look at the profitability metrics. Net income and earnings per share are both down a staggering 35%. So that win now strategy, it is definitely not winning, at least not yet.
But here's where it gets interesting. Despite all of this terrible news, look at this. The overwhelming majority of Wall Street analysts still have a buy rating on Nike stock. It seems like they believe the company has hit rock bottom and that the sheer power of the brand will pull them through this, even if they've had to lower their short-term expectations. When you zoom out, this whole story is about so much more than just Nike.
What's happening to them is really a symptom of a massive shift in the global retail landscape. It's a wake-up call, really, for every single Western brand out there.
What we're witnessing is really the end of an era. That China gold rush where Western brands could just show up and expect easy, explosive growth, it's done. It's over. Local brands like Anta and Li Ning are just winning. And get this, Adidas is actually starting to recover in China because they've adopted a totally localized China for China strategy. It's something Nike might have to seriously think about.
And that really brings us to the final lingering question. For decades, Nike has literally defined what it means to be a global brand. But now, facing these completely new and unprecedented challenges, you have to wonder, is this just another hurdle for the king of sportswear to clear, or are we actually witnessing the end of an era of dominance for the swoosh?